To feed a bubble like this, which is going on nothing but stimulus, it takes more and more stimulus. If you just pull back the stimulus, you're weakening it. And if you go to neutral or taper a little bit, so I think they don't understand how overvalued the markets are.
What at this particular stage makes you feel as though that resilience is finally going to break in 2022?
Well, you know, it really is this first crash, and I'm not convinced yet, because when you have this much support, you got to realize we printed $3.5 trillion, the Fed, after the 2008 crisis, the first few years. And then it kind of planed out, and they just kind of went it steady and just holding high stimulus, but not increasing it. We printed $4.5 trillion, probably going on 4.6 or 7 now, just in the last 2 years. This is an incredible jolt. And what you get, David, and I've been warning about this, yes, you can keep stimulating, and they can keep doing it more and more, which they are, but it is diminishing returns. And so the fact that they even have to print $4.5 trillion just because of a short-term crisis, COVID, shows how little they're getting now, and the fact that the markets are down this much. Like you say, they're resilient. They're resilient for a good reason. All this printed money, they didn't send checks, which I would do. If I was going to stimulate, I would send it to households to spend, or businesses, okay? No, they're just basically buying bonds and financial securities in the markets, which means more money, new money, not coming out of consumers and the economy and businesses created by the government, that's going directly into buying financial assets. And it starts, the government buys bonds, but then those people sell the bonds and they trade up the higher yield bonds and then the stocks. And so it goes all in, all financial securities go up. And the biggest beneficiary for this type of stimulus is always the stock market. Real estate too, all financial assets, but the stock market does the best. So the stock market is resilient. And that's why I'm telling, what we need here is for the markets to go down enough to break the confidence that has been created, because you got to realize that, I mean, you know, people aren't stupid, okay? When year after year they just print money out of thin air, and that's the only reason the economy's going up, you got to start saying, hey, this doesn't really sound sustainable, like it makes sense. But it has worked long enough. So that's why I say, first of all, this is what history says. I mean, 9 out of 10 bubbles are going to crack. I mean, they're going to make half the crash in the first 2 or 3 months. That is what it takes to jolt people out and say, hey, sorry, folks, this bubble's over. This has to happen to break it.
So Harry, it doesn't sound like you're predicting the crash because of a recession. But the question is, will the crash create a recession, right? I mean, there's the wealth effect. And of course, this would create the inverse of wealth effect when people start to feel less confident because their 401ks, their brokerage accounts are worth less. So will that create a recession, which then has a snowball effect to make the markets even worse?
Yeah. I mean, you couldn't have said it better. This is what happens in this case. There's been so much support and so much money in the markets. Interest rates are so absurdly low compared to inflation. They're all negative, okay, even more so in Europe and other places, that basically, you know, the economy still has momentum until something breaks it. And that's what it takes. It takes a sharp enough of a crash. Again, it could just be this Putin thing in Russia, you know, but the point is these markets are so overvalued, and all they're doing, they don't realize, they're saying, oh, we're just going to go more neutral and taper a little bit. Look, to feed a bubble like this, which is going on nothing but stimulus, it takes more and more stimulus. If you just pull back the stimulus, you're weakening it. And if you go to neutral or taper a little bit, so I think they don't understand how overvalued the markets are, how the economy does not have the fundamentals it did in 2007, when the baby boom generation was spending more money and working harder, becoming more productive, predictable things. Now we're all aging, including me, okay? And aging is bad for an economy. Ask Japan. Ask Japan when they've seen a new high in their stock market since 1989. The answer is never.
I know.
So it sounds like the only thing the Fed could do to push this, kick this can down the road, is really not try to fight inflation, just to say, hey, we're going to keep stimulating, and that could kick the can down the road. But you're saying just by stopping the stimulation, not even reversing it, just by stopping it,
just by pulling back, the economy's only growing.
The bursting of the bubble.
You got to remember, when the baby boom generation was rising, it's supply and demand. It's people growing up, earning and spending more money, and that creates more commerce, and that creates better jobs. And then, you get this positive cycle. Supply expands because of the aging of a generation into their peak, not into their old age like now, into their peak, into their late 40s, is a win-win for the economy. Now, that's been over since 2007. I was the guy that was as criticized as I am today for being bearish. I was criticized for being too bullish in the late 80s and early 90s. I was saying, you don't understand, this generation is going to drive the greatest boom in history just by growing up and becoming more productive workers and higher spending consumers, which is 100% predictable. I mean, nothing more predictable. People spend the most money at 46. If they're an everyday person, and if you're an upper 10, 20% person, it's 54, okay? So these are predictable things. Now it goes the other way, and the government says, well, wait a minute, we can't, especially with all these bubbled up financial assets, if we don't keep this thing going despite the lack of natural spending and productivity, then it's going to correct and crash, and then the president won't get reelected and the Fed won't be popular. So they've been forced into this game of just pumping more and more. And what I think they thought, David, really early on, and this is kind of odd, they thought, okay, this was 2008, it was just a temporary financial crisis, and if they just put in $1 trillion in 2009, which they did right away very strongly, that would be enough to get the economy on track. They don't understand that the largest generation in history is stopping spending, and the next generation will not come along with enough strength for 14 years to offset it. That's what I study, and that's real stuff. So they thought that'd be enough. So they were naive in that. But you can't be naive 13 years later when you're still having to print money and print money and print more and more money. It's telling you that without this money printing, we would have a very weak economy, which is reality. When the economy finally goes down enough to burst this bubble in the stock market, you're exactly right. The biggest thing driving the stock market, and it is because wealthier people spend a lot more and get more benefit, this stock market going up has made people unbelievable rich. Real estate, I mean, people's house has gone up 3 or 4 times, and the upscale people's real estate and their assets have gone up a lot more because they have a lot more financial assets.
And if you're right with what you're projecting, that's all going to turn around because stock market has a major correction. The wealthy don't take traditional mortgages. They'll just, leverage a stock account to go ahead and buy a piece of property in cash. So we'll have to see how it all pans out. I agree. You've caught a lot of flack lately for being excessively bearish, as some would say excessively.
I was bullish, that most of my career. I started doing this in the 80s, and I was the guy that saw a bigger boom than anybody else. I got criticized for predicting a Dow of 10,000 by 2000 in the early 90s. People thought I was crazy. It went up to almost 13.
Harry, it must be a conspiracy. The Fed is out to get you. They want to make you look silly. So we'll have to have you back so we can check in a few months and just see if we're getting anywhere near that 46% drop.
And exactly, but that's the key thing. If you see, that is the confirmation that the bubble's over. If we get that 40% plus crash within 3 months, and we're 7 weeks into that, so we only take about another month, 5 or 6 weeks to see if this is true. If we get that, it's telling me the bubble's over and you got a lot more coming. If not, it means they may drive us up one more time into maybe March or so to a near new high or something, and then we worry.